Hey there, it's Mitch. You're watching Be the Boss of Your Money. This is my live stream about investing, personal finance, and all those good things that you need to know so that you could become better with your money. We're going to talk about artificial intelligence. We went off on that yesterday. I should say off in a bad way. We spoke a lot about the new GPT from Microsoft. They took a huge position in OpenAI and Google's chatbot. Google stock got just mauled today because of a snafu with their uh, with their test of the AI. They were showing it off, and it was answering questions, and it got them wrong. It's people like, what the hell's going on here? Anyway, the stock plunged on that. It's kind of, I don't want to say comical, but yeah, it's comical. Okay. We're going to talk about the macros of investing, and we're going to go through the general market close update. And more importantly, we have big news in from Disney. Big news. And this is something we've been positive on uh, about Disney's ability to hang on to live streaming subscribers. So it's a big deal. I just got this message from StreamYard. We're having trouble streaming to Facebook. This may be an issue when Facebook ends. Is it possible the stream was ended or deleted on Facebook? We'll keep trying to let you know. Okay, so I don't know if this is going to Facebook in the live stream or not. I might just have to post it later as a replay. But whatever it is, the show must go on, and we have some really interesting things to talk about. I'm actually pretty pumped up for today. I'm excited about this. Here we go. All right, it's good to have you. We are just getting started. If you're joining me now, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream about investing, personal finance, smart decisions with your money. There's a lot of news, and we take this in and we break it down with perspective so that you could walk away from the show with like just this complete understanding of what's happening in the world of finance all around you, and so it can help you make better financial decisions and keep you invested. Because if you are prone to, and a lot of people do this, they sell at the wrong time, they buy at the wrong time. If that's you, and that could describe almost every one of you, right? We've all done that. That's who the show is for you. Okay. And it's hopefully you're interested in this kind of content. So we had the big the big two things that we were focusing on this morning were yesterday's speech. Jerome Powell, the chairman of the Federal Reserve, spoke at the Economics Club in Washington, D.C. He was interviewed by David Rubenstein, and he spoke about inflation. He introduced the new word to the current financial lexicon, which is disinflation. It was it was transient. Inflation is transient, and then inflation went up and stayed up. So now he's talking disinflation, meaning the rate of inflation is coming down. So it was 9%, then 8, then 7, now 6. Disinflation. Prices are not necessarily coming down in a lot of places, but they're not going up as fast. But in some places, prices are going down. I don't know if you know this, but on Monday, the wholesale price of eggs dropped by half in one day. It looked like eggs are in a bubble, believe it or not. And that is going to eventually wind its way down to the supermarket shelves, and you'll start to see the price of eggs coming down. I've already seen that. I know this stuff gets political when you talk about prices of food because people will use it as a cudgel, right? Or as a cause or an issue. Do whatever you want. The fact is, tens of millions of chickens had to be culled, aka slaughtered, because of a severe deadly avian flu. It, it affected massive amount of livestock birds, and they had to be killed off. And that's what happened. It's going to take a little time to regenerate the herds, make new baby chicks, more females to lay eggs, more roosters for chicken dinners, and that's what we're facing. And the other, okay, so Powell spoke yesterday. He used the word disinflation, and people are hoping that he would stay more or less dovish, because last week after the Fed raised rates last Wednesday, he sounded more dovish, like our rate policy is working, prices are moderating. And people think they don't have much more to do, maybe a quarter point more, 2 quarter point hikes, and they stop for a while, reassess, maybe cut rates end of the year. Then the gigantic employment figures came out. 517,000 new jobs created, unemployment rate the lowest since 1969. And you talk about revisions, like that number is so big, you'd expect it to be revised lower. I'm still expecting that. But the 2021 and 2022 non-farm payroll figures were revised, and they were revised higher. So the labor market the last 2 years has been even stronger than expected. And the interest rate hikes that the Fed's using to slow the economy down to bring down inflation, it's not really impacting, the jobs so much right now. And even with a large number of job cuts at big tech firms, those job cuts have not really spilled into the general economy yet. Now, after the close today, Disney announced that they're going to lay off 6,000 or 7,000 employees. I mean, these are big numbers, but we need to see like hundreds of thousands of layoffs, not thousands. But companies are changing. Companies are getting more tech savvy. When you see a company like Disney lay people off, there's probably a good chance that you could say, even if good things happen going forward for Disney, and things are happening that are good for them, those job losses are permanent. But so far, people who lose their jobs have been able to find other jobs. More jobs are being created than lost. In fact, job openings also went up by about 1 million job openings. That was reported last week also. The other thing was the State of the Union last night. States of the Union or State of the Union addresses are not really substantive events. And I don't know if anybody expected last night's to be a substantive discussion on policy. They are rah-rah speeches, red meat for the base, tout the things that they could tout, whoever the president is, Republican or Democrat. They tout the good things. They kind of, avoid the bad things, try to relate to the audience, which is you and I, the TV viewer. And that's basically what they are. They're more theater. They're more theater than substance. We know that. But it does give us all something to talk about in terms of what could get done and the budget ceiling debate coming up, things like that. Okay. Yes, Stephen says political theater. Did you say it before I said it, or did I say that before you said it? I'm giving you credit, Stephen. Thank you so much for tuning in. Hey, guys, while you're watching, if you want to learn more about myself, my partner, Bobby Bird, what we do here, check out clientfirststrategy.com. If you have any questions, okay, Stephen says yes. So, yes, you said it first. So, I think you said so. Good for you, buddy. Thanks for stopping by. And I'm glad. You know what? My viewers are smart. You are smart. Thank you very much. And apparently, you're in very good shape also, because I see you always doing those great things at the gym. Good for you, buddy. You're really taking care of your health. And you're welcome. So, we are moving forward. What the heck were we talking What the heck were we talking about? Okay. If you want to learn more about us, check us out, clientfirststrategy.com. If you have any questions you want to ask now, hit us hit up in the comments like Steven is doing. I love hearing from you, especially in the comments when I'm doing the live stream or even in the replay. It's the best part about doing this, the interacting with you. I love it. It's so much fun. And if you wouldn't mind, give us a thumbs up, an applause or a heart reaction, whatever it is, because when you do that, it makes me feel good. I get a better gauge of who's watching and what kind of content I should come up with. And the other nice thing is it helps spread the good word of the good work we're doing here with the rest of your connections. And we really appreciate that. We really want to reach a lot of people and teach about personal finance. Okay, that's exactly what we do. State of the Union forecast for the next few months. We shall see. When it's your State of the Union speech, you get to forecast what you want. Certainly not going to forecast. Well, you forecast bad things if you don't get your way. You forecast good things if you do get your way, right? That's how these forecasts work. So let's move on and let's take a look at how the day went. So we had Jerome Powell yesterday. We had the State of the Union last night. Pretty much by Friday, we are going to forget all of the stuff anyway, but it's important to cover now. Let's take a look at how the overall averages did today. And I'm going to pull up another screen for you. Let's do this. Let's pull up another screen. Okay, right here. So Dow was off about 200 points, gave back most of the gains from yesterday, but this is what we do. The NASDAQ was down rather 200 points, 1.68%. So the Dow and the NASDAQ were down about the same number of points, but you could certainly highlight the percentages. The Dow was only down 0.6, and the NASDAQ was down just about 1.7%. S&P was down in the middle, down 46. Gold up a drop of less than 1%. It was up fractionally. Oil was up. Oil has been on a tear, though. It's gone from oil keeps going to the low 70s to the low 80s, and that seems to be the trading range. We'll see if it breaks out. I hope it doesn't break out to the upside, but we shall see. If oil goes down a lot of you might be thinking that's good, but if oil does break down a lot, that's probably not a particularly good indicator for economic strength. Just so you know. So be careful what you wish for. You just might get it. The 10-year yield 3.6%. So like we were talking last week, the yield has been going up. It was expected to go up after last Friday's employment figures came out. It means the economy is doing better than we thought. It means the Fed's going to keep pushing the brakes, tapping the brakes for a little bit longer in the economy, and therefore bond yields go up a little bit, but the long bond, the 10-year is up a little bit. As a result, mortgage rates are up a little bit, and the VIX was up still a little under 20. And in the bond market, let me get out of here. Okay. Rates backed off ever so slightly, but the 6-month Treasury bill, the T-bill, is almost 5%. The 1-year 4.8%. These are pretty good yields for short-term stuff. And someone said to me, "Well, why don't I just go into CDs? CDs are safe." I don't want to imply that an FDIC insured CD is not safe. It's a stable investment. It's FDIC insured. But CDs invest in treasuries because treasuries are guaranteed. They're the safest. Short-term T-bills are considered the risk-free rate of return. These are the safest of securities there are. Okay? Backed by the full faith and credit of the United States. Although that could change because of the budget, budget seal negotiations. So we don't want to give up on our full faith and credit of the United States. I promise you, we do not want to do that. Okay? I think it's a really bad idea to say the United States no longer has full faith and credit of the bond market, behind the bond market. So let's take a look at what's going on in after market. Okay. Let's see. Disney to cut 7,000 jobs as it slashes costs and reorganizes. It's up 6% right now in aftermarket trading, up $6 at 117. So congratulations to Disney. It's a stock we've been talking a lot about. It's a stock I've been talking to clients about. Uh, I have to be careful with what I do as far as recommendations on the live stream, on the radio show, etc. But if I've been talking about Disney a lot lately, I'm not a short seller. Let's put it that way. If I'm talking about something, it's typically because I have a positive construct or positive view on it. Read between those lines, okay? See the lines? Read between the lines, okay? How's that for putting it in a not too blunt way? And let's take a look at what else. Okay. Let's take a look at like one of the big stories here is Alphabet. And we're going to talk a little bit more about the stuff. Alphabet shares fall 7% following Google's AI event. AI means artificial intelligence. All right. So how did Google do today? Down 7.6%, down over $8. And gains this year, even though it's been a good first month, this certainly takes a lot away from the year-to-date gains for Google, even though it's still up 12.63% on the year. What happened is, from what I understand, is Microsoft had this big event, GPT, to show off their artificial intelligence. And this artificial intelligence that Microsoft is doing and that Google is doing, to me, it looks like it's pretty much going to give you the same thing. You make a query in search, and instead of getting lines and lines of different articles and videos, and you've got to go through that stuff and figure out which articles you're going to read, which ones are useful, which ones you don't want. And the way the search engines typically work is they pick the most popular or the most widely viewed content, not necessarily the best or most accurate content. So what happens is Microsoft is getting into that too. But Google tested it out. And what you do is when you do these chatbot inquiries, these artificial intelligence inquiries, what happens is you get like one report, like a neatly, very well written, grammatically perfect text report. Tell me about the Gettysburg Address. Here's the report. You want it in a page, you want it in 2 pages, you want a college level paper, you want a high school level paper, and it'll give you exactly what you need in one report and just go through terabytes and terabytes of data instantaneously to generate this report. It could generate audio, it could tell other machines what to do. It's really amazing how quickly it works. I wouldn't say it's thinking yet, all right? But Google, kind of comical, stock got hit on this news. And I want to show you something that I posted. I'm going to show you what I posted on LinkedIn today about artificial intelligence and financial advice. Okay, so I posted this today. I'm going to show you right now my LinkedIn post, okay? That's a picture of me. I was in New York City. And if you want to know where I was standing, I was actually standing in front of the Jacob Javits Center in Manhattan. Okay, so if I was any further east, I would practically be in New Jersey, but I was still on the island of Manhattan by the Jacob Javits Center. You see the Empire State Building behind me. This actually is not a new photo. I took this photo probably early spring of 2022. It's my daughter and I went to the New York International Auto Show, and she's the one who took the picture. So shout out to Jessie. But what I wrote in it is, please don't confuse your chatbot inquiry with my fiduciary financial advice. And the copy or the text that went with it, I'll make this a little bigger, okay, that went with this is this. Billions upon billions of dollars have been invested in AI, artificial intelligence, and it's accelerating. Condensing terabits of searchable content and creating reports out of it will be a huge time saver. Fact is, AI has been used by corporations for a long time. directing phone calls, internet search, financial services, regulatory compliance, risk tolerance questions, and much more. But the new thing today is how Microsoft and Google are bringing AI tools to the masses. It's a watershed moment for sure. It's the next big thing from the internet. But it can't measure your fear. It can't tell if your personal loss caused you to be sad or if being sad caused your personal loss. There is no empathy. It can spit out a financial report about Disney, but it can't tell if Cruella is mean or nice. It can't create an investment or financial plan that you could stick with because it can't measure your anxiety. It can't spur you on to buy life insurance because it can't tell if you love your new baby. But it could tell you what life insurance is. So with all of the technology and information we have at our fingertips, have people gotten any better at financially preparing for their future? No. Will AI give us more information? Yes, but so what? The reason the financial advice industry exists is because humans are emotional creatures who have a propensity to do dumb things when our emotions run high. Financial advisors do two things that AI/chatbots cannot do: tell you what to do and tell you what not to do when your emotions dictate the opposite. Here if you need me. And what I mean by this is there are certain things that chatbots and artificial intelligence and these new chat GPT uh, software appliances, whatever you want to call them, could do. It's great that if I want to report on Disney or if I want to report on the Battle of Gettysburg, I could get it based on the level of for elementary school, high school, college, PhD. It could give me a report and tell me uh, it could tell me about anything I want to know about. Okay, you know, cars that have the most complaints. It could give me a report. It can't tell me what car is best for me. I could get served up with advertisements, and that certainly is part of artificial intelligence. It can't tell me that if I'm sad because something bad happened, it can't tell which happened first. Did I get sad first and cause something bad to happen, or did something bad happen that caused me to be sad? It can't give you empathy. It can't advise you. It can't do investigative reporting. It could spit out a really good legal brief, but it can't actually convince a jury because we need convincing. If all you have to do is give a human being a logical, well ordered, well written piece of prose, I I could see AI impeding the service industry. If you're talking about legal, accounting, financial advice, that sort of thing. But it doesn't do those things. It takes a human being to convince another human being. And sometimes people need to be convinced of something that's good for them because they've been misinformed or because of a level of poor education, okay, or just a general lack of knowledge. And that's what a human could do. Remember, people don't care how much you know until they know how much you care. Chatbots are not viewed as caring. They're just good like Google does an internet search. Does Google care about you? Does the internet search engine care about you? You know it doesn't. You just like it because you could use it. It's convenient. It saves you a lot of time. You don't have to go to the library to look something up. You don't have to buy an encyclopedias every couple of years so that your kids could do their homework. They have Google. That is what chatbots do. They could tell you how much your balance is on your cell phone bill, right? But they can't tell you to call your mother. They can't tell you to call your mother because you haven't called your mother in like 2 weeks and she's dying to hear from you. That's what a chatbot can't do. Financial advisors do things for their clients, just like doctors and lawyers and anybody else. And that's why I'm not particularly worried about chatbots. Um, So that's my story, and I'm sticking to it. We already have robo advisors, but all they do is they take a risk tolerance questionnaire from you. They get the answers. They spit out a general asset allocation model, and then it puts together a portfolio of funds or ETFs. I've been doing that, and they rebalance it. I've been doing that like for like 25 years for people. So I don't see what the big deal is if a computer does. And when I do it, it's electronic. Like there are mutual funds with fund of funds that do all that for you. They're already built. So I don't know why robo advisors are such a big deal. Okay, now let's talk about the macros. The macros when you eat in the food world. Excuse me. Get a little dry in here. The macros in the food world are protein, carbohydrates, and fat. Well, the macros in investing are stocks, bonds, and cash. And how you set up your macros determines what you eat, the quality, quantity, the health of what you eat. When you set up your asset allocation models using your macros, again, cash, bonds, and stocks, you determine how much you have in each of the macros, in each of the general assets, the macros of assets, okay, financial assets. That's what you need to know. And that determines most of your return. And within the stocks component, the stocks portion of your portfolio, from there, you pick other things like international stocks, large cap growth stocks, mid cap value stocks, international, et cetera. And that's what I like to convey to people about asset allocation. It's the macros of the investment world. I hope that makes sense, and I hope that clears that up. I thank you so much for watching. I'm going to get going. If you have the time, tomorrow morning, I will be on the radio as I am every single weekday morning. I'm on LI News Radio, 103.9 FM. If you cannot receive it, you can download the LI News Radio app. It works great. There's a triangle at the bottom. You tap the triangle, and the radio plays, and it's terrific. I'll be on. My time slot is exactly 9:06 a.m. to 9:30. It's 9 to 9:30, but I don't go on until 9:06. We've got the news, the traffic and weather, commercials, things like that. I am still deciding if I should stream the radio show here on Facebook, YouTube, LinkedIn, Twitter, etc. But until I decide what to do, I just have to see. It's kind of a distraction to stream and do the radio show at the same time, and I don't want to lose my focus. So that's it. I will see you tomorrow. Either way, either on either you'll hear me on the radio or you'll see me on social, and I will speak to you soon. Thanks so much.